How many of you are hoping the market takes a big fall? Another 10%. Hey, what's the rest of you hoping for? How many of you don't care because you can make money in either market? All right, that's where the most of you should have your hands up, right? Because honestly, it doesn't matter. I mean, yeah, I'm going to go through a bunch of boring statistics, and I got some charts and graphs for those engineers in the room that like that stuff. And, you know, I'm going to try to spruce it up as much as I can and make it fun. But the reality of it is, if you're a well-versed real estate investor, you can make money in any market, right? You can make money going up, you can make money going down. Or you can make money going sideways, which is what we've kind of seen recently. Just this steady up, but not really much of a spike and certainly not much of a fall. So I'll just jump right into it if I can make my clicker work.
Oh, mine didn't turn on. On the side. I forgot to turn
You gotta be smarter than the clicker. Oh, you got green. Here we go. All right, so like all speakers, I put together a disclaimer. This is intended for information and training purposes only. The presenter does not guarantee any of the information in the presentation, because I got it from a lot of sources, which I'll share my sources with you at the end. It was pulled from multiple and sometimes contradicting sources. Right? So I go over here and they say, this is what happened, and I go over here and this is what... I'm like, why do these economists not even know? Right? Okay, so don't rely on anything in this presentation. This is just for your entertainment, more than anything, okay? It's just entertainment. But do your own research before you invest or take any investment action. And certainly this is not meant to be tax, legal, or investment advice. And my favorite line, nobody has a crystal ball, right? All of this and even the conclusions I'm going to share with you at the end of what I think is going to go on over the next 12 months, it's just one man's opinion. Just one man's opinion, okay? So let's start with 2019. I got 3 slides. We'll do a little recap. And I always like to do this to hold myself accountable for accuracy as much as possible. I like to put up the slides of what I said last year in my conclusion slides, and I will share with you publicly whether I hit or whether I missed. And I had a couple of misses this year. I wasn't happy about.
How would you mind if we took pictures?
I'm sorry?
Would you mind if we took pictures?
I do not mind if you take pictures. I don't care at all. There's nothing top secret in here. 2019, in my opinion, from an economic standpoint, was a year of very few surprises. There was one surprise. But really, there were very few surprises. We had a wild card last year that we talked about, and that was price of oil. A lot of you can't remember where we were 12 months ago. I can't either. That's why I had to go back through my slides. Well, that was a big thing. We weren't sure what oil was going to do. And basically, oil prices stayed pretty flat. They kind of leveled out just under $60 and kind of stayed there for the whole year. And I think that contributed a little bit to the job growth numbers, so we'll get into that in a minute. The one thing that I totally missed was that the Federal Reserve actually lowered rates. Now, you remember a year ago, they had just raised rates a quarter point before we went into this January meeting, and all indications were that they were going to continue to try to inch that up another half point to a point. And what happened is they couldn't. They just couldn't. Here's what happened. When they raised rates, there were no bond issues for 40 trading days. Not one single bond issue for 40 whole trading days. Freaked the Federal Reserve out, as it should have. And they took the advice of somebody on Pennsylvania Avenue, because if you recall him chiding them about raising rates, he's like, you're going to crash the economy, you dummies. And, he might have been able to soften it up a little, but that's not his style. But he was proven correct over the next 40 days, and they completely reversed course and actually last year dropped rates by 0.75 points. Other than that, there wasn't a lot of unexpected happenings, which is great. When you have unexpected things, they kind of throw a curveball in the plans that you laid out the year before. So we like a year, at least in my house, when there aren't a lot of unexpected things that went on. So my conclusions from last year was that nationally and in Houston, job growth and GDP would still be strong. I said that in Houston, I thought we'd hit somewhere between 2 and 3%, and we actually hit 1.9. So I missed that by just a smidge. Companies, I said, will have a hard time filling positions, and in my opinion, that would push wages up, right? And I know in our office, that certainly was the case. We've had a devil of a time with the growth that we have had over the last 12 months, filling positions, which means we've had to pay more than we have had to typically pay for those same positions. And the national numbers came out that wage growth actually has now started to go up as well, which is always a lagging indicator in an economic boom. And it was up 1.7% through September. I said it would probably be around 2%, but August's numbers was 1.5%. So it is still trending up. And September is the last number we have available to us right now. I still might get it, but I still might fall a little short too. Who knows? We won't know for another 6 months on that one. In Houston, I said, I think we'll see 50 to 55,000 new jobs created in 2019, unless, and there was a caveat, oil prices stabilize around the $60 mark, in which case, I said, we could see as many as 70,000. We actually had 71,000. Okay? Single family market, I said, I think we're going to remain strong and prices are going to continue to rise, although they will moderate a little. Sales were up 4.8, prices were up 2.3 on average, and 3.2 median. Houston, as we get into the hard numbers here in a few minutes, set all-time records in pretty much every category of housing and real estate. So that certainly did come true. I said I thought that the single-family market would hit another record in sales, and it certainly did. We'll get into those numbers in more detail. I thought that the hottest price point for flips would be under $500,000, and that certainly was the case. Higher price points would continue to struggle, but would recover and be in positive territory, and they were. We'll get into those numbers. Actually, they got a little more positive than I really thought they would, particularly from where we are in oil. Rental market, I said I think that would continue to expand and rents would continue to go up, and they did. I thought rents would go up 2 to 3%. They hit 2.4. I said I think wholesalers will continue to get 80% on their deals instead of 65 or 70, which is what I'd like to pay, and they do. I also predicted that more lending products would be coming out, products that you haven't seen before, and that is certainly happening. I have new lenders contacting us all the time, wanting us to market their products, and some of these products are stupid. Some of these products are stupid. What does that tell us? When lenders start offering stupid products, what is to follow?
Crash.
Foreclosures, right? Yeah, maybe not a crash. That's a drastic term. But yes, certainly some foreclosures. I thought that interest rates would climb, and man, I missed that one because, like I say, the Fed did a total 180, which I think they should have. I didn't think they should have been raising rates when they did. So I missed those two. Multifamily. I said, I don't think cap rates are going to change much. And I get this question all the time. You know, those folks that know me know that I've done a lot of apartment deals and I love doing multifamily deals. And I always get asked, when do you think the prices are going to go down? When do you think cap rates are going to go up so we can buy again? And my answer every time somebody asks me that question is the same. Not this year. That's all I can tell you. Again, go back to the I don't have a crystal ball thing, right? I can tell you what I think is going to happen in the next 12 months based on all the data that I'm going to share with you that I go through to do this. But I don't think anybody can tell you what's going to happen more than 12 months out. I just don't think, if somebody says they can, I would be very leery of that, right? So I don't see a change in the next 12 either. Sorry, apartment buyers. I know there's a lot of you sitting like I am, just waiting, ready to pounce. I don't see it. I just don't see it. Apartment occupancy, it clicked up a little bit to 90%, but it was 89 a year ago. That is a small number. And because of that, cap rates have remained constant, which simply means they're not really that good a deal right now, in my opinion. So what I'm going to talk about, I'm going to mostly talk about the Houston MSA, Houston Metropolitan Statistical Area, which is 9 counties surrounding Houston with a larger economic output than all but 23 of the countries in the world. Did you know that?
No.
The Houston economic output of those 9 counties put out more economy than all but 23 of the countries in the world. Let's say it again. The Houston economy has over 3 million jobs. We just clicked over that mark about a year or so ago. It's like 3.2 now million jobs in that area. On net, this is something I learned new, 60,000 people each year move to Houston. Now I understand the traffic on I-45. I get it now, okay? That's on net. That means more people moved here than that, but some left as well. But we ended up with 60,000 more per year. That is roughly 165 new people per day on I-45. Okay? Or 10, or whatever your favorite road is. Here's something else that was interesting that I found this year. Our over 65 population is growing by 30,000 a year in Houston. We are aging as a population in Houston, which is actually very ironic because I moved to Texas 14, 15 years ago. And one of the things that drew me to looking at Houston, which I had never even been to, by the way, when I picked it to move to, was the demographics. And it had such a young population at the time. The average age in Houston when we moved here was 31. That's clicked up now about 2. So that's huge. Conversely, the place I moved from, average age was 34 and a half. And you don't think that's a big difference, but it is a monumental difference over 6 million people. So why would that be important to know? Why, this little bit of information, that little nugget, how could that help you?
How's it being built? Apartments?
I'm talking about the over 65 population going up by 30,000 a year.
Or nursing home?
If you were getting into assisted living, right? Somebody here was talking about assisted living. Might this be a good market for that, right? I could think of a lot of things. If you're raising private capital, who has private money? Who has private money is the people with gray hair or no hair, okay? That's who has the money, right? I like more gray hair and no hairs because I raise a lot of money. So that's a good thing. That's a good thing for me. Jobs, jobs, jobs. That's what we're always wanting to know. How many jobs we're going to create? Because the jobs create the economy, right? I keep a running total here. I don't know how long I'll keep it going, but for the last 4 or 5 years, I've got the job totals there. In 2015, the Houston MSA created 200 net new jobs. 2019, it was 71,000. Yeah. And it's just been steadily increasing every year for the last 5 years. Now, I can tell you most of the economists that I've read to put this together are predicting a slowdown of job growth. And they're predicting, it depends on which one you read, anywhere from 40 to 50,000 new jobs in Houston in 2020. But look where that puts us. Still puts us in pretty good territory, doesn't it? It still puts us in very good territory. So let me back up. I'm going to ad lib here a minute. So do y'all remember maybe 6 months ago, if you were watching the news channels, there was about a 2-week period where they were using a word in every sentence, in every talk, and in every panel discussion. Recession. Thank you. Do you remember that?
I do remember that.
How many of you remember that? How many of you caught that? See, words mean things to
I
me.
didn't understand it.
Well, it's because it was BS. That's why you didn't understand it. Okay? It was political. It was political. The news organizations were trying to create a recession for political reasons. And they thought we were so stupid that we would believe them over what we were seeing in our bank accounts and in our wallets and all around us. It only lasted 2 or 3 weeks. You haven't heard the word since. But I'm just saying that as a precaution. You will hear a lot of this kind of stuff this year. Why this year? A presidential election year, right? That's even worse. That's when things get totally screwed up and nuts, in the media in particular. So you just focus on the facts, the stuff you know. These are facts. Nothing that I'm going to share with you is opinion until the last 3 slides. I'll give you my opinions. Everything until then is 100% bulletproof fact, and I'll give you my sources for those. Okay? So don't be manipulated by the manipulators on the television. Please. They have an agenda this year. They definitely have an agenda. All right, Texas jobs. Texas is on pace. Again, I'm doing this talk in January. It'd be much easier for me to do this talk in 3 more months because all the numbers would be finished for last year. A lot of these things won't be completed for another few months. But we are on pace to add 300,000 new jobs in the state of Texas. That is the most of any state in the United States. Hell yeah. A little bit of Texas pride there, right? Texas unemployment dropped to 3.4 from 3.7 last year. It is insane. You understand, at 3.4, if you're trying to hire people, you're in trouble. I can tell you from experience. Because most everybody that's got a job, or wants a job, has got a job. They call the last 2% of unemployment is what's called hardcore unemployment. That is people that don't want a job and wouldn't take one if you paid them to. Okay? Which means the real unemployment from an employer standpoint is right now sitting at 1.4. And from an employer standpoint, that sucks. That sucks. Okay? Because it makes it very hard. If you've got people on your staff, if you've got people on your team, take care of them, lavish them, do whatever you got to do to keep them, because somebody is going to try to steal them from you. I can assure you. Okay? Oil. Can't do this talk in Houston without talking a little bit about oil. Energy makes up over 30% of Houston's job market, and it is our largest driver of jobs. And to this year, most people agree that we're going to lose oil jobs this year. More. I should say we're going to lose more oil jobs this year. And even with that, what did I just say? How many jobs should Houston create this year?
40 to 50,000.
Most economists are saying 40 to 50,000. Yeah. I'll give you my opinion at the end, but most of the guys, if you get on and start reading, that's what they're saying. So, isn't it amazing how resilient Houston's economy has become? Yes. You understand, back in the 80s when they went through the oil bust of the 80s, right, and you could shoot a cannonball through any glass building and not touch a soul midday, right? I mean, because they were empty, just ghost buildings in Houston. That we do not have that same dynamic today. We have so many things going for us. that even when oil does take a little turn, we're still creating jobs, still creating good jobs. Wages are still going up. So the energy sector, you can see the price of Brent and WTI, that's West Texas Intermediate. That's the standard for U.S. oil. Brent crude, that's the rest of the world's standard. And you can see that, we're just hovering in that, 50s to low 60s range for the last 3 years, really. The energy sector is shaky right now, not because of the price of oil, though. I mean, granted, if it bumped to 80 or 90, you'd see definitely an influx of oil jobs. But really, the biggest issue driving the energy sector is a lack of credit in the oil sector. For the last 4, 5, 6 years, people in the energy sector, particularly upstream, that is on the exploration and drilling side, they could get easy credit. There was tons and tons of money thrown at that sector. And they didn't even have to be profitable to get that money. They were able to borrow on revenues. So as long as you could show more money going through your bank account every year, didn't matter if any of it stayed there. As long as it was going through and it was growing, tons and tons of money was thrown at those companies. And Wall Street, private equity firms, and really even private investors as well, have all kind of put a kibosh to that and said, you know what, we're tired of waiting for those profits you were telling us we would get if we invested with you. Until we see profit, we're not lending. And that has created a huge credit crunch in the upstream energy market, a huge crunch. And because of that, we have a lot of bankruptcies starting to accelerate in the energy market. I'll get to the bankruptcies here in a second, and I'll show you the graph on it. But if you look here, this is the U.S. oil rig count. 2017, it was 929. 2018 was finished out at over 1,000, 1,050. Right now, we're at 794. So you can see how the oil rig count is just kind of dropping off. I don't see that changing anytime soon because global demand for oil is slowing. It's not growing at the pace that it was. We're getting more and more energy efficient. Automobiles are getting more and more energy efficient. Houses are getting more and more energy efficient. China is slowing down their growth exponentially. I mean, they were, several years ago, they were like 12 and 13% year-over-year growth. They're building cities in the middle of nowhere that have no people. That's no lie. You can look it up. Ghost cities of China. It's fascinating how that totalitarian regime thinks they can grow an economy without people. The growth. Yeah. I've been trying to wrap my head around it. I can't get there. I just can't get there. But all of that is playing into this global demand for oil is slowing down. And we got more and more players in the oil market, right? And these players are kind of fighting to get that share. So this is your rig count. Now this is the rig count back to 2013. So you can see it's been tailing off. But then this is a snapshot just of here. And you can see how dramatic that tail really is when you look at it on a more condensed graph. So without rigs, what's that mean?
Unemployment, people.
Well, it does, yeah, because it's not just the guys, the roughnecks that run the rigs. It's all the guys that manufacture all the stuff that goes into the rigs, it goes into the wells. It's the servicing companies, right? It's the office buildings full of people that are doing the bean counting and doing the engineering. All of those jobs kind of go away when you don't have rigs. So it's a huge impact. Oil industry bankruptcies. I told you I'd share this graph with you. So year before, 2018, there was, 40 bankruptcies between oil producers and oil servicers. Last year, we're up to 50. And it's expected that that's going to continue. Mergers and acquisitions isn't on this chart either, but it's just below bankruptcy, right? Because if you don't go to bankruptcy, you still got to do something to reorganize. So a lot of them are just doing mergers and acquisitions, trying to shed off some of the white-collar workers so that they can survive to fight another year. Now, I talked last year about upstream versus downstream. Upstream is before the oil comes out of the ground. Downstream is after the oil comes down out of the ground. And we're in the Houston metro, so could you think of an area of this metro that would be affected by downstream?
Baytown.
Yeah, Baytown, Texas City, LaPorte, right? All the refinery areas. So while the drilling and exploration are soft right now, it has had no effect whatsoever on the refinery towns. In fact, you could argue that they're even doing better because why? Price of oil. That's their feedstock, right? So if price of oil is down, that means it costs them less to make their chemicals. That costs them less to make plastics, costs less to make resins, costs less to make all the refined products that they sell. So yes, upstream there's some issues, but downstream, no issues. In fact, they're investing billions and billions and billions of dollars all up and down the Gulf Coast, okay, on the refinery side. And the oil production numbers are still climbing. We are now a net exporter of energy for the first time ever. I think it actually happened in the previous year. But we're now a net exporter of energy. That should make everybody in the room feel good because we are now considered energy independent. If anything ever happened like it did in the 70s when OPEC, this criminal cartel in the Middle East, I softened it up. I softened that up. If they ever decide that they're going to push the prices to a point of no return, we can say, keep your damn oil. Keep your damn oil. We don't need it. We don't need it, right? Now it is truly a global market. And now they have to play the rules a little differently. They really do. Barclays is a great source for those of you that like to do your own research. The Barclays forecast is basically a survey that talks to as many energy executives as they can to see what is your forecast for growth or spending next year. And they're actually not expecting to spend anymore. They're expecting to decrease budgets next year this is for drilling and exploration by 5%. So this contraction that we've been seeing, it's not done. It's not over yet. We're still going to see some contraction. The U.S. Energy Information Administration is forecasting prices for West Texas Intermediate to be somewhere in the $60 to $65 a barrel range for the entire year of 2020. Now, honestly, I don't see that as an issue because these guys know how to make money at 60. They do. Are they going to have to do some consolidation? Are they going to have to trim some fat because they had some really fat years there for a while? Yes. And they're in the process of doing that. But at 60 to 65 bucks, we can still hum.
Everything's pretty much profitable.
Absolutely. Everything is pretty much profitable at that. Yep, definitely. So I don't see that as terrible, terrible news, but we are going to still see some restructuring. We're still going to see some of that. Current investment in oil, the red, the chart with the red, that's capital invested in oil companies, right? Energy companies. And as I told you about the credit being cut off.
Wow.
See that? Less and less money is going into energy companies. Now the other over there, that's Y, okay? These are the S&P 500 stock returns to oil producers and oil servicers. So if you're an investor and these are your returns, you can see why they're putting less and less money into those companies, right? There's cause and effect. There's cause and effect there. So until these guys over there in this chart can start seeing some up, you ain't going to see some up over there. It's that simple. Okay? If I don't return a good return to my investors in my private equity funds, they stop putting money in it. Would you? I mean, that just makes sense, right? And that's just all that's going on there. Okay? All right, I'm done with oil for a minute. Let's go to the port system. Another huge driver of jobs in Houston. The United States has 450 port systems, and Houston is ranked number 2 in overall tonnage. The only port that pushes more product than ours is New York City. And as far as international tonnage, we beat them. We're number 1 for pushing stuff in and out from across the oceans. So the Port of Houston is continuing to expand. If you've been reading or keeping up with this, it is a phenomenal story. It started about 3 years ago. I started talking about these super tankers, right? That's why they opened up the Panama Canal and doubled the size of the Panama Canal so they could get those super tankers through. And these super cargo ships. They're called Maxes. They're huge. Houston is the first stop, basically, when you come through and come up to the United States. And from Texas, you can ship pretty much anywhere to the midsection of the United States. If you're pushing stuff to the West Coast, doesn't make sense to do that. Just go to California. If you're pushing stuff to the East Coast, that's fine, go there. But if you're pushing product through the whole midsection of the United States, Houston's your best place. And the folks at the Port Authority are doing an amazing job. Just this year, the Barber's Cut Terminal is announced they're doubling the size of their gate area. Now, the gate area is where the semis pull up and they have to be checked, right, because of security. That's a national security spot, considered a target of opportunity for bad guys. The average turnaround from when a truck pulls up to that terminal to when he goes out, gets his container, and comes back through is 53 minutes.
That's if he's lucky.
That's average, according to what I read. Now, I'm not a trucker, so I have no stories one way or the other. But I just thought that was fascinating. And then, in addition, they're doubling the size of that so that they can get more and more trucks through there. They also, 2 years ago, they put in all new cranes up at Morgan's Point. Now, Bayport is getting 3 more new cranes, and they'll be the tallest cranes in the port system. They're setting them up to handle these big cargo ships. Those 3 cranes cost $35 million. They're putting tons and tons of money. The biggest talk now in the port system is deepening and widening the ship channel. That's the biggest talk now. So we'll see where that goes. You got a bunch of competing factions there. The politics is loading up on that. Tonnage for the year was up 7%, but loaded container traffic is up 11%. So we are the container capital of the Gulf Coast, basically. Port of Texas City. It's only a liquid port. There are no cranes, there are no cargoes. There's no drive-on, drive-off ships come in there. It's just petrochemical. That's it. And it's the 4th largest in the nation. The Galveston Cruise Terminal, part of the port system as well, 4th largest in terms of passengers in the nation, and it's number 1 on the Gulf Coast. And Galveston, just this year, crossed its 1 million passenger mark for a year. And more cruise passengers last year out of Galveston climbing on cruise ships than in any year previous. And it is just continuing to expand as well. I was in if y'all ever want to do an event, a party or something of that nature, there is a cool event center in Galveston. It's called the Tasting Room at the Falstaff. So the old Falstaff Brewery complex. Our lending company actually lent the money to rehab that building. It's a 6-story building, and they rehabbed it into self-storage. But up at the top, they have an event center, and you can see water all the way around, 360 degrees. We had our Christmas party there in early December, so it would have been a couple of weeks before that. Royal Caribbean Cruise Line used that center and penned a deal for a $100 million investment in the 3rd cruise terminal in Galveston. We're getting a new terminal. They're actually breaking ground, I believe, in April. They've already started doing some of the dock work, and Royal is going to bring in a huge ship. It's one of their Aurora or Allure series, Oasis. The Oasis class ship, it'll handle 6,500 passengers. That's like double and a half the largest one that's down there now. So Galveston is going to be a huge cruise hub in the very near future. Now, why does that matter to y'all? If you ain't from Galveston or don't go to Galveston much. Well, yeah, you might think about investing, right? You might think about looking at Galveston. Sorry, Steve. Now everybody knows. He's known for years. But you know, what's good for anything in the Metroplex is good for everything in the Metro, right? People that are going on those cruises, you think they're all leaving Galveston County to go on those cruises? No, they're coming in from Oklahoma. They're coming in from all over the place. They're flying in. Where are they flying in? Flying into Houston. And then they're renting a car, or they're getting a taxi, or they're getting an Uber. All of that fuels the Houston economy. Every dollar that comes into our Metroplex helps fuel the economy. So all these things are good, even if you never go to Galveston. Doesn't matter if you never see that cruise terminal. It's still good for us because we all benefit from it. Houston's not done growing either. You know, we're talking about this slowdown, and the media was talking about recession and all this, but the reality is there's 8 new mixed-use projects that are underway already or are proposed at this time. Some of these are huge, huge projects, okay? For example, this one here, the McNairs, have a $500 million high-end mixed-use development that is scheduled to be open in 2023. When City Center became as successful as it has been, now developers are wanting to reduplicate that all over Houston. You're going to see that type of, I'm pointing that way, I have no idea why, I don't even know where the hell I am. But, just pointing to Katie. Yeah. But anyway, you're going to start seeing that type of project duplicated all over town. Convestro, that's a petrochemical company over in Baytown. They're doing it's a little expansion of $1.7 billion. You know, just a little expansion there. So do you think there might be a few more jobs over in Baytown as a result of that? Yeah, just might be, right? That was actually interesting. When I was studying that project, they said that the construction jobs were going to be hundreds of construction jobs. And when it was through, they felt that it would create 35 new full-time jobs. 35. Really? So don't think there's going to be like thousands of new jobs because of all the money they're spending. They're expecting 35 new jobs when it's completed. But it's the construction that's really going to help. because that's going to create a lot of jobs. Let's talk about consumer confidence. You know, I bashed the media a little bit ago, trying to make a point about how sometimes our thoughts are manipulated, right?
Sometimes.
So why would media try to get us to believe that a recession is coming? Because of this chart. Consumer confidence drives the economy. If you don't feel confident in what's going on in the economy, you're going to do what? You're not going to spend. In fact, you might start pulling back, paying off a little debt, socking some money away. And if everybody did that, what would happen to the economy? Recession. Yeah. They could literally speak it into existence, or at least that was their dream, was to speak it into existence in an election year. It didn't work, and here's how we know. Last year, consumer confidence was at 120.2. This year, it's at 131.6. If you look, I mean, there's just not been any place on that chart clear back to 1977 that was any higher, except for right here in the around 98 to 2000 range. So people are feeling good. Why are people feeling good? Because of their wallet, right? Because of their wallet. They see what's going on. Small business optimism index. This one is really good because it should tell us what kind of growth we're going to get going forward. Are small businesses going to expand? Are they going to hire more people? Are they going to spend more money? Or are they going to start pulling back? And this one is actually, in my opinion, a little shaky. It is higher than it was a year ago, barely. No, I'm sorry. It's really close to the same. It was 104 last year. It's 102.7 right now. But you see it's been up, down, up, down, up, down over a short period of time here. I think a lot of people are expecting recession. Would you agree with that?
Yeah.
How many times when I was standing out there before I started my talk, people asked me, so is it going to happen this year? Is it going to happen? It's like everybody's just cocked and loaded and ready for it to happen. And I think a lot of small businesses, which that's what we have in this room, is it not? A bunch of small business owners. I think a lot of people are sitting waiting for that to fall, waiting for that to drop. And I think it is reflected here. Now, consumers do not feel the same way we do. They're out there spending, they're out there doing their thing, and their confidence is high. But it is much higher than small businesses are. All right, let's get into real estate since that's what y'all are here for. Home ownership rates. I always check this every year to see how it's going. Home ownership is great. We're at 64.8 right now, and it was 64.4 the year before. I like to see this in the mid 60s to high 60s. I think that's healthy. If it gets higher than that, then it's hard to rent properties, right? Because everybody owns something. They're not going to rent. If it gets a lot below that, then that means people are not comfortable buying a house, or interest rates are too high for them to afford it, or something is wrong. So this, I think, is a very healthy place for us to be. Real estate sales, this is full year 2018 according to HAR, and 2019 side by side. Single family home sales, we set another record at 86,000 and change, up 4.8% year over year. Total properties went over 100,000, and dollar value of all real estate sold in the 9 counties that we talked about. That's a heck of a number, ain't it? $29 billion. That is a crazy number. Again, another record. Single-family average home price is creeped up to $303,000. I don't really follow average price that much because it's skewed a lot by the real high-end stuff. I like median price. Out of all the homes, if 1,000 homes were sold, what did number 500 sell for? That's called median price, right? And that is actually $245,000. That's up from $237,500 a year ago. So it's climbing as well. One of the dangers that a lot of people that follow this stuff and have lots of big degrees and letters behind their name are talking about, and I have none of those things, is the fact that Houston is getting overpriced. You know, we used to be known as the most affordable big city in the country, and they're talking, saying, "Oh, we're going to lose that because our prices keep going up." Just be a contrarian for a minute. What if that were happening in all the big cities? Would we not still be the most affordable big city in the nation? And guess what? It is. It is. So I don't agree. I don't agree with them. We are not as affordable as we were 3 years ago. Well, yeah, of course. But are we still more affordable than the three larger than us? Chicago, LA, and New York. I'm going to take those at the end. Thank you. How about the three larger that are a little bit smaller than us? Philadelphia, Phoenix, Atlanta. Are their numbers not going up too? Yes, they are. They are. So we are still affordable when compared to others at the same time frame. Are we as affordable as we used to be? Well, of course not. Of course not. Another thing that I like to look at is just December to December numbers, because looking at a whole year could maybe miss a trend, right? You could have had a great first 3 quarters of the year last year, and then it fall off like crazy the last 3 months, but we still set a record, and we sit in here thinking everything's rosy. So if you look at December to December and break that out, you kind of get a better picture if there's a trend that's going different than the annual numbers. And looking at this, I don't see any trend different. December 19 was still a phenomenal year over December 18. Dollar volume was still up 18% year over year just for that month. Actively, I mean, everything on there, it points to we're still solid. We're still really solid as a market. Here's the one that really drives everything else on there. Can you tell me which one it is?
Months of inventory.
Months of inventory. Look at that number. Months of inventory. We have no inventory. A neutral market is, they say 6. I disagree. In Houston, I think it's different. I think in Houston, it's 5 to 6, right? That's where I think a healthy, neutral market would be. And how long has it been since we have seen that?
5 years.
Longer than that.
6 years.
I'd argue longer than that. We would have to go back to just after the housing crisis of 2008 to find that number. We just have no inventory. So I think that's going to play into next year's numbers, because it's hard to set a record selling houses when you got no houses to sell. Would you agree? So now that doesn't mean that we're going to have a bad year if we don't break another record. It just means we didn't have enough inventory to fill the demand. Why are we constantly running behind? Anybody know? There's 2 reasons.
Demand drop.
Or growth.
People are moving here, somebody just said. 60,000 new people a year moving to Houston. All of them need a place to live, right? And 68.4% of them want to own a home. That was a national number, but let's assume it's the same here. And then the other thing. Back in the 80s, real estate builders, home builders in Houston got pummeled because they overbuilt. We have the smartest home builders on the planet in Houston because of that story. Every home builder is afraid of overbuilding and being the last guy when the music stops. Okay? They do not want to be the last man standing when the music stops. So our home builders are very cautious. They are very methodical. I say that as a group. Obviously, there are some that aren't. But you're just not going to see them overbuild and get to the point where we're going to have 6-8 months of inventory like other cities. Other cities have huge ups and downs, right? Particularly big cities. They have huge swings up and down in their inventories. Not Houston. Our builders learned a lesson, and these guys probably weren't even building back then, but they heard stories, and they are not about to repeat that. So, currently our inventory stands at 3.4 months of inventory. Nationally, it's 3.7. So nationally even, this is a problem all across the country, okay? I won't say problem. It's where we are across the country. And these numbers are down from a year ago. Not a lot, but certainly a little bit. Broken out by segment, by price point, this was the December numbers. So the only price point that decreased in sales was the under $100,000 house. Why do you think that one decreased? Is there nobody that wants under $100,000 houses? They don't exist. Yeah, exactly. They're kind of getting phased out. They're just, again, lack of inventory. There aren't any to sell. So those numbers are always going to be dwindling as there are less and less of them available. The next one, 100 to 150. Why do you think that one decreased? Same problem. Same problem. I mean, 150 is the new 100, right? I mean, so, yeah. But everything else where we do have some inventory, all increased, including the 750 and aboves. They were even up almost 13% year over year. Talk about foreclosures. This is one of the leading indicators, I think, of when we're going to see this debacle. And we'll even go deeper than that. We'll get into defaults here in a second, because that's an even more leading indicator. But on foreclosures, you know, Q2, quarter 2, 2019, that is June 30. That is the most recent numbers we always have available to us at this time. They are slow as can be getting those numbers out. But right now, we're sitting, as of the last numbers, 95.47% of all mortgages were current. A year ago, 95.6% of all mortgages were current. I mean, yeah, there's a little increase, but not enough that I could get excited about or worried about, either one, depending on where I was. During the last crisis, that number was at 86 to 87%. That was in that 2008-2009 time frame. So just to give you a point of reference. That's the U.S. foreclosure activity, clear back to 2005. And I really like this graph. I just found that this year. I've never used it before. The blue at the bottom is the defaults. And then the next one up, the yellow, is the auctions. And then the red is the REOs being held currently by banks and institutions. And as you look out where we are, and this one is accurate to October 2019, there's just nothing to talk about, really. There's just nothing to talk about. There's no trends upward. If anything, we're staying the same. Or you could argue if you put a linear line on there, we're even declining a little bit in defaults in that blue line. So not really anything to jump up and down about there. Mortgages that are underwater, that's another good metric to know when things are going to happen. 5.1 million mortgages were considered seriously underwater as of the last data. That only represented 9.1% of all mortgages, and that was not changed year over year or month over month. So there's just really nothing happening in the foreclosure market to speak of. So if you're wondering, man, why can't I get any foreclosure deals? Why can't I get any REOs? That's why, because there aren't really a lot of them out there. And if we broke this down by city, you would find that Houston's even in better shape than the national numbers I just shared with you. When I talk to institutions that are selling packages of REO notes, REOs or notes, I always ask, are there, because they'll have a package of maybe 2,000 of them or 200 or whatever it is. And I say, well, what percentage is in Texas? And they laugh at me. Like, oh, you're cute. We don't get them in Texas. We don't get them in Texas. So even if you broke it down by city, it'd even be different. Okay, for you apartment investors, 17,000 new units will hit the market in 2020. That's up from 15,000 last year. And we've got 22,000 new units under construction. Another 28,000 are proposed. Means they think they're going to build them, but they haven't started yet. Okay, not all of those will make it to construction. Occupancy right now is 90%. This is where I think this one is interesting to me. If I could find a crack in all the information that I've shared with you tonight, this one gives me more of a glimmer than anything else. Because occupancy rates are kind of steady and have been for a while. And we're tacking on more units per year than we have in years.
Rates are going to go down.
It could be interesting. I'm not saying that it's gonna. I'm not willing to predict that. It would be another couple of years before we would see it. But I do want to go on record of being the first one to say that could be interesting in a couple of years when we're sitting here. Okay? I'm not convinced that they are not overbuilding apartments right now in Houston. There's a couple of things that play into this that I don't have on the slide. I pulled bullet points to throw on the slides to give you something cute to look at. But I read a lot of the stories behind it. And a couple of the interesting storylines to this is that all the apartments that are coming online, what price point are they?
Higher.
2,000 and above. 2,000 and above. Okay? The old saying in the apartment business is they ain't building C-class apartments. Okay? Right? Nobody goes out and sets out to build C-class apartments. So, this is the start. If I'm seeing what I think I'm seeing, this is the start. But it's years away. You've got occupancy at 90% across all asset classes. Okay? You dump thousands and thousands more units onto the market. Right? But those units are priced high, which we've all agreed. That's what's going on right now. Right now, the average concession on new constructions hitting the market is 3 months free rent.
Oh.
And they're having to do that just to fill them.
Wow.
Mm-hmm. You guys should get excited about this here in a minute. Okay? What happened? Now, nobody in here probably is out buying A-class apartment complexes. So why should you care about this? It sure does. It starts there. That's 99 out of 100 times where the pressure starts. It starts at the A-class stuff because that's what gets overbuilt. And then they have to start lessening the price, lessening the price, lessening the price, right? So now you got people going, wait a minute, I'm living in an A- apartment complex, and that brand new facility over there is offering 3 months free rent and a big screen TV, and they'll help me move. Well, hell, what am I doing here? So they move over there. Now you've got the A minus apartments that have lost a bunch of people. So what do they got to do? Lower, lower, more incentives, more incentives. Now you got the guys in the B class apartments going, wait a minute. For what I'm paying, y'all understand. And that trickles all the way down to the D class apartments. It trickles all the way down. How long does that take? Depends. It depends. Every cycle is different. But that's how the compression on apartment prices happens. That's where it starts. Now, in the same time, you want me to give you a little bit more apartment news?
Yes, sir.
It's not on here, but I'm going to throw it at you anyway if you want it. And during that same time, those pressures on those apartment complexes are compounded because now they're not bringing in as much as they were and were expected to bring in. So now they don't have money to spend on the complex. So what now has to happen? Either capital infusion, which 99 times out of 100 isn't going to happen, or they start skimping on repairs, on the maintenance stuff. And then what happens? The people that are living in there, well, this place is crappy. I'm going to move over here. And we call that the death spiral of an apartment complex. And it can happen in any of the classes. Typically, it's going to happen in the B's and C's because the A's are so well capitalized, they're not going to let that happen. But the buyers of the B's and C's typically are not that well capitalized. They're leveraged to the hilt. And when they are not at that occupancy that they had to have to make that run, guys, I've been in B-class apartment complexes that were sitting at 75% occupancy. And I would ask the management, I would say, well, show me your vacants. I want to see those vacants. Because I'm thinking, if I buy this, how much I got to put into it to get them up and ready to put on the street, right? And you walk in, and the furnace is missing. Walk in the bathroom, there's no toilet. There's just a hole in the floor. And you go through, and there's stuff missing through. I think, this is weird. When I first started buying, I'm like, this is weird. They're cannibalizing vacant units to repair occupied units because they don't have the money to go buy a new furnace or a new toilet or a new AC condenser. Y'all didn't know that. Some of you didn't know that. Happens all the time. But when is it going to happen? When occupancy falls below where they needed to break even. Okay? Just food for thought. All right, so occupancy's strong right now, but I'm saying a couple of years out, if they continue, they being our apartment builders in Houston, they continue cranking out, 20,000 units a year. That could be interesting. It could be interesting. So we will look at that next year.
The apartment builders may not be nearly as smart as
The apartment builders may not be as smart as the home builders. I don't know. We will find out, right? Rental rates are expected to rise 4.2% this year. Now, don't get excited about that if you own apartments and say, dang, I didn't raise my rents enough, right? That 4.2% is an average of all apartments, okay? And a lot of that is due to higher priced new inventory coming on the market that pushes that number up, okay? That doesn't mean that the existing units went up 4.2%. New projects are filling up at a much slower pace than in recent past. This again is just kind of proves it's not a theory yet, but my inquisitive nature, okay? Let me go back here. I didn't put that on, but there was another statistic that I thought was interesting. Projects that were finished and opened in 2017 have still not filled yet. They're still not full yet. And yet we're still cranking out another 20,000 units. Yeah. The average that builders like when they're putting a new apartment complex on the market is they want to have it up to 90% occupancy within 18 months. 2017 finishes are still not there. They're still not there. They're at about 82 or 3, I can't remember, but they're still off. Interest rates, this is always huge when we're talking about real estate. It's one of our big drivers other than jobs. I always like to keep this first line on the slide because I want y'all to remember what normal is. And because most of you in the room haven't seen normal, right? But normal is from 1995 to 2008, the average interest rate for a 30-year mortgage was between 6 and 8%. It was never any more and never any less than that for that whole time frame. The lowest on record was November and December 2012 at 3.35. That is the lowest on record that I could find. And the highest, I didn't even put on there. But in the last 5 years, rates have been what I consider artificially low, which is great for us as borrowers, but horrible for you as savers. Right? Because if rates are low, it's great if you're a borrower, but it sucks if you're a saver. Because what do you get when you take your money to the bank? You don't even get a damn toaster anymore. Well, when I was a kid, they at least give you that when you started a new account, right? These are our interest rates, and it's just still really, really, really low. But it's great for real estate because that means you can sell that couple a bigger house. You can sell that couple a more expensive house, and they can afford it because people buy on rate. People buy on payment, and the payment is dictated by rate. Would you agree?
Yes.
So that's driving prices, and because people can afford a bigger or more expensive house, they're buying them. And because of that, prices are pushed up. So as long as rates are low, prices are going to continue to go up. It just makes common sense. This is a Fed funds rate chart. Really nothing to talk about there. It looks like a massive increase, but we started at 0. So really, we're still at nothing. We were at nothing. We stepped up, and we're still at nothing. Here's some interesting topics. I was trying to find something new for this year. You know, a lot of this stuff I've already introduced to you over the last few years, but we've got a couple of new things that we can talk about tonight. Talk about some trade deals. Okay? The China trade deal. Anybody heard about that? A couple of you? Okay. So, not too long ago, it was announced we got a new trade deal with China. That is trade deal phase 1. Okay? It's expected that it'll be in 3 phases. But phase 1 has been agreed to already, and it's done. And these are some of the bullet points in the trade deal. It's actually pretty awesome if it turns out the way that it was written, because it provides enforceable protections. Enforceable protections, not just promises, right? And these protections should block the theft of intellectual property, the theft of trademarked products, patents, counterfeiting, and those types of things that have been so prevalent from China forever.
Taiwan.
Huh?
Taiwan too.
China also agreed in this deal to buy 50% more of our products than they did in 2017. 50% more. That is $200 billion more in goods and services that we'll be able to export. Oh, what does that really mean for the economy? That means that we're all going to buy what we buy, right? We all, based on our consumer confidence index in our own mind, we go out and buy what we are going to buy. And our consumption really is about 2/3 of the U.S. economy. But if you add another $200 billion in buying that we don't have to do to the economy, yeah, this could be huge. It really could. $32 billion more in agriculture, $52 billion more in energy. That's the one that caught my eye. 78 billion more in manufactured goods. Who would have ever thought we would be sending manufactured goods to China? I mean, all those boats that come over from China with all the Walmart crap in it, they're going to have crap in it when they go back now. Instead of going back across empty, they actually go have something in them. I thought that would be cool. So I think that's going to play into the economy as well. And honestly, these two slides, this one and the next one, I do not believe the economists that I was reading took any of this into account when they made their predictions. The USMCA, y'all heard that?
Yep.
Y'all know what that is?
Yes.
What is it? It replaced NAFTA, right? It replaced NAFTA. And it just got signed into law yesterday or day before, right? So it's a done deal. It's an absolute done deal. When I read through, I mean, you read this, you need to do it when you're not ready to go to bed, okay? It's agonizing to try to stay awake as you read this crap. But there was some neat stuff in there, okay? So, number one, has nothing to do with most of us in the room. It removed a prohibition on the NFL that existed that said if you broadcast your NFL games in Canada, you have to run the United States commercials. That's no longer in there. Well, what? So what, right? Tom, so what? I thought that was cool because it was wrong. The way it was wrong. And our negotiators said, no, we ain't agreeing to this anymore. If the NFL is going to broadcast in Canada, they ought to be able to go to Canada and say, hey, Mr. Business Owner, do you want to advertise on our broadcast? We're going to play the game Sunday night. And the Canadian business owner here might say, yeah, I'd like to advertise. More revenue. Lots more revenue for the NFL. I also thought this one was funny. It removes all the barriers for U.S. dairy products in Canada. You know, what? I didn't even know there was a barrier on U.S. dairy products in Canada. There is. It was a huge barrier. Now that's gone. So our dairy producers can now sell their goods in Canada. These are the big ones, and these you probably already heard. I'll hit them quickly. It requires now 75% of a U.S. automobile to have content, 75% of an automobile to have U.S. parts in order for it not to have to pay tariffs. So the idea of General Motors, I'll just pick on them, since I own a few of them, saying, hey, Mexican labor is cheaper than American labor. These union guys, they want too dang much. We're just going to run down here, right across the border, and build a plant, and these people will work for nothing. Well, guess what? You can do that, but you're going to have to pay huge tariffs now to bring that automobile, when it's finished, back into the United States. But if you use 70% of the parts that go into it from America, we'll let you go down there and create some jobs in Mexico too.
That sounds too fair.
It sounds duh, right? Right? And it requires 70% of the steel and aluminum that goes into an automobile to be U.S. steel and aluminum. It also requires 40 to 45 and there's a bunch of sub-chapters I won't get into. Basically, the Reader's Digest version is 40 to 45% of the parts that are not U.S. parts. In other words, those parts were made at a plant right beside the GM plant in Mexico. Okay? Those 45% of those parts have to come from factories that average a wage of $16 US an hour or more. What's that going to do for Mexico? Mm-hmm. Yeah. And speaking of all these things are tied. All these things are tied together. Okay. It also includes huge criminal penalties for theft of trade secrets and for cyber theft. Guys, this is huge, and nobody's talking about it. The media isn't going to talk about it because it's good news. Okay? They're just not going to talk about it. They want to get you down. So what does all this data tell us? I already said nobody has a crystal ball, but I really believe that somebody can come to some reasoned conclusions if you've got enough data to look at. And that's what we're trying to do here tonight. Any conclusions that you did come to based on what you've learned tonight will be based on things that have already happened. That's the best we can do, right? But like any investment prospectus will tell you, past performance does not guarantee future results, right? So we have to keep that in mind because we cannot see unforeseeable events. And those types of events could take us off the path we think we're headed down. So keep that in mind as you're making your plans and using the data that I've shared with you. Here's my conclusions. Last two slides. Nationally and in Houston, I think job growth and GDP is going to continue to grow, but I think it will slow a little bit. It cannot stay hot forever. It just can't. And we're starting to see little things, but it's still going to be a good year, in my opinion. It's still going to be a fantastic year. I think Houston's growth is going to still be 1 to 2%. Wages and salaries, I think that's going to be up for another year at 1 to 2%. It's always a lagging indicator. So that one's easy to predict, okay? Because it's based on this year's job growth, okay? It's not rocket science. In Houston, I think we're going to see more than what the experts are saying. I think 50 to 55,000 new jobs created because of these new trade deals. I think they have discounted what those are going to do over the rest of this year. But the real growth from those trade deals is going to be 2021. That's when things are really going to... Look, people will take a long time, right, to build factories, set up, recruit, hire, train. The biggest challenge we're going to have with growth is finding people who want to work. That's the big, because most of them that want to work are working. If you are not, it's by choice, okay? It just is, because there are 7 million unfilled job offers in the United States today. 7 million unfilled jobs as of today. If you're not working, it's because you don't want to. The Houston single-family market, I think it's going to remain strong through 2020, but I don't think it'll set another record this year because I don't think we have enough houses. Not for lack of demand, but for lack of supply. Okay? I think home prices are going to continue to rise. They may moderate a little bit, but they're still going to continue to rise. Foreclosures may slowly accelerate a little bit, and here's where the foreclosures are going to happen more than anything. I think when we look at real estate as investors in the room, we should be looking at this thing as real estate should be split into two. Retail real estate over here and wholesale real estate over here. I think we're going to see a lot more wholesale real estate foreclosures. We're already seeing a huge amount of that year over year. And a lot of you don't know that, don't see that. But as a lender, talking to all the other lenders I know, and talking to borrowers who are in trouble and getting themselves into jams, I can tell you that in the wholesale real estate side, the flipper side, there's real problems in our market right now. And they are due to the prices that they have to pay to get the deals. So they are overpaying, and their plan is a hope and a prayer. And that's typically not a real good plan. Okay? So this side of real estate, I think that's where you're going to see the most of the foreclosures. This side, not so much. I don't think there's going to be a big change. Okay? Rental market, that's going to continue to expand. I think rental rates are going to go up another 1 to 2% for existing rental units. Like, if you've got rentals, you're going to be able to continue to bump those rents. Wholesalers are still going to get 80% for their deals, which is what's going to fuel the wholesale flippers losing their tails and losing their houses. Okay? Because they're continuing to pay that. New lending products are going to continue, and they are going to be stupider and stupider by the year. I'm just calling it as I see it. And I think interest rates should hold steady. I think the Federal Reserve, Mr. Powell learned his lesson when he tried to raise it a quarter point and froze up the bond market for 40 days. I doubt that he'll try that anytime soon. Those are my conclusions. Multifamily, I don't see any change there either. I think the apartment vacancy rate is going to remain relatively low. Occupancy will still be in that 89-90% range throughout the year. And if that happens, and I'm correct about it, I don't see any softening in prices, which means they're still going to be, in my opinion, too expensive. Too expensive for me to buy. You might like those prices, but I'm not so keen on them. And for those of you in the room that keep asking me, look, I know the apartment market will drop someday, but I still can't tell you when. I can just tell you I don't think it's going to be in 2020. The potholes. These are the things that I think we should look out for that could change some of my conclusions. I think home sales may level off. Again, I've said this before, because of lack of inventory. If the builders can't keep up and that 3.4 stays there or even declines more, home sales numbers will be off. But those of you that have homes for sale will do very well because you have very little competition in your market. Okay? I still think that reduced inventory is going to lead less experienced flippers to paying too daggone much for their properties. If you want to know where I think the big one is, the big one, right? The big one that everybody's waiting for. I think it's in debt. And I didn't get into all of those statistics and all of those charts and graphs because Steve is ready to kick me out already. I'm already 20 minutes over. And I don't think it's going to really play that much in 2020. But I do want to mention it because I think that's where the next crisis is going to come from again. Right? It's where it came from last time. Political upheaval could also be a huge detriment to the economy. And I think 2021 is going to hinge greatly on the outcome of the elections this year. It's going to be a crazy, crazy year. It's going to be a year just to not even watch the TV news, right? Just focus on your business and growing your stuff and do what you got to do. So what would I suggest? Make a plan. Based on what you've heard here tonight and do some research of your own, make a plan and stick with what you've had success with. I don't think right now is the time to go out and try a bunch of other things that you don't know whether are going to be successful for you or not. Build simple systems and just rinse and repeat. This is a good year to just churn it out. I would also say don't bite off more than you can chew. Okay? If you have done really well with rehabs under 300 grand, don't go out and try to do $1 million rehab. I don't think this is the year to start biting off big chunks and taking big gambles. I also think in preparation for the next year's talk and the year after that, you should work really hard on getting your financial house in order. When I say that, I mean paying off all the debt you can pay down. And what you can't pay off, refi it into long-term debt. With the rates as low as they are, get that stuff locked in as long as you can. Anything floating that you've got, try to get it into something fixed and long. Don't pay too much to get a deal, obviously. Sell off unperforming assets. Underperforming is what I meant to say. Every year, my wife and I go through every single asset we have and say, is this one doing what it? No? Well, then screw it. Why do we own it? Just so we can say we own one more house or one more whatever? No, that's not a good reason to own it. If it's underperforming, sell it. Why would you sell it now? Prices are high, right? Prices are high. Now's the time to slough off all the garbage in your portfolio, okay? And then always market, always market wholesale what you don't want yourself. If you don't want it and it's not a deal for you, it doesn't mean it won't be for the guy next to you. because guys next to you are paying lots, right? And then keep a few a minimum each year if you can, and build up a rental portfolio. If you want to take a picture, that is my sources that I used for this year's talk and all the stuff that I looked at. Feel free, take a picture. I'll hang out for a little bit afterwards if you've got any questions, and I know you have the first one about rural areas, and that's my contact information. If you have cash to invest, I'd love to talk to you about that. And I do a little thing I do 3 or 4 or 5 times a year called 2 Days with Tom, where a couple, usually, doesn't have to be a couple, will come to my ranch and we spend 2 days talking about this type of thing and your business and building a plan for you. And when you walk out of there, you will have a very, very good understanding of what you should be doing for the next 12 months. I do that like 3 or 4 or 5 times a year. And if you want to talk to me about that, it does cost money. So just understand that. But it's 2 days. We just hang out on the ranch. I've got a high-fenced hunting ranch with exotic animals from all around the world, hoof stock, not tigers and lions. Said that one time and somebody thought I was raising Bengal tiger. No, different types of deer and antelope and things like that from around the world. So if you're interested in that, that's my contact information. I'll be happy to talk to you. Thank you very much for your attention.